All right, hey guys, how you doing today, man? Welcome to the Real Estate Millionaires, and I want to introduce somebody who is going to blow your mind. I met him through my partner Mike, and he has an amazing, presentation and a bunch of great stuff. He's going to change your mind. So please tune in and share this with all your friends. My special guest and friend, Yonah Weiss. Hey, how you doing today, brother?
What's going on, Nate? Thanks so much for having me. Happy to be here.
Nah, man, thank you for coming on, man. So we'll just jump right into man, I know you specialize in cost segregation, and for those of you who don't know, that means that, hey, I'm going to keep you from paying taxes, and you're still going to be able to use this money and add it back into your income and get loans, correct?
Yeah, that's correct. It's a amazing strategy. A lot of people don't really understand or know enough about, which hopefully we'll be breaking some of that down today.
Absolutely, brother. So I know you have a presentation, man. Do you want to share your deck, or you want to share your deck with them and show them? I've seen your presentation before, and it's amazing even to me, and I know some of this stuff, but I was like, man, you have my attention, brother.
We're back. The magical world of cost segregation. So you guys, I understand a lot of you people are in real estate, and obviously getting into real estate is probably one of the best pieces of advice anyone can do, because regardless of if you're doing it full time or whether it's just an investment on the side, maybe something you're looking to scale, it is not only a great way to build income and a separate income stream, but a great way to build generational wealth. And one of the greatest things that comes along with real estate investing is this little thing called tax benefits. Okay. Yep. Tax benefits you may have heard of before, and you may have heard of the 1031 exchange. You may have heard of some other stuff. Cost segregation is probably the number one. But because it's usually talked about only in the commercial setting, a lot of people, when they're starting out, miss out on it. And because it's a tax-related strategy, but it comes along with a whole engineering component to it, which we're going to talk about, a lot of people miss out. Because I think their CPAs don't even do it. They can't do it. And so your CPA may not even be telling you about this because they don't even know what it is.
Yonah, man, so that's amazing that you said that, because people don't believe it when you tell them that. You say, hey, look, man, listen, I'm not sitting here. I don't want to down your accountant, but man, he ain't doing it right. So in your experience, man, even from single family homes, and I don't know if you're going to break this down, but we got over 50,000 people in our group. And I did a breakdown yesterday, which I haven't shared with them, but I'm doing a class putting that together. And I showed them how we did a house, but instead of taking the $40,000 in renovations and putting it towards the basis, we were able to take the accelerated depreciation and the 27.5-year items we had to put in. But are you saying they can even do this in single family homes?
That is correct. You can do it on any type of property. I mean, we'll talk about a little bit where the real benefit is going to be, because it is I don't want to get ahead of ourselves here, but it's a proportional benefit. So the higher the tax basis, right, the higher percentage of the tax benefit you'll be able to get from that. But potentially it could be done on any type of property.
Wow. Man, that's amazing, brother. Well, hey, man, I've seen your presentation before, and like I said, it blew my mind, man. So I'll let you kind of take charge, brother. I just want to see. I got my pen and paper, man. I'm watching and I'm writing down, brother.
All righty. Well, happy to be here. So basically what we're going to do, we're going to break it down like this. What is cost segregation? Depreciation. Okay. Really what this is, like Nate mentioned, this is really depreciation. It's an accelerated form of depreciation that allows you to take those deductions faster. We're going to talk all about it, break it down. What are the benefits of getting this done? We'll talk about bonus depreciation, which everyone loves a bonus, right? This is something huge that is actually going to be going away in a couple of years. So we want to make sure to take advantage of it while we can. Who should be doing this? Is this for everyone? It's for every type of property, right? Every big, small, and which type of property? When is the best time to get this done? Is it a timing thing? Does it need to be done the first year? Can you do it retroactively? We're going to get into all of that. And most importantly, what's a real estate professional? This is actually a huge, important piece of the puzzle over here, because as we will show you directly from the tax code, someone who defines themselves as a real estate professional gets many more tax benefits than someone who just has a W-2 job and has investments on the side. So all this we're going to get into. We will do a case study. I have in this. I didn't have one for a single family. We'll do a multifamily property case study over here, and let's just jump right into it. So, and if you do have questions, Nate, if anyone, I don't know if on the live or anything like that, people are questions going to come up, but feel free to stop me at any point. So when you buy a property, depending on if it's residential or commercial, it doesn't matter. As long as it's not your personal residence, you get a tax deduction called depreciation. And it's not what it sounds like, that it's a bad thing, right? Depreciation, it's going down in value. No, this is a tax deduction based on the principle that things go down in value as time goes on. But it doesn't mean your property is going down in value. It just means you get to take a tax deduction, of your whole property over the course of ownership. So if you buy a building, a property, doesn't matter what it is, you get to now take the entire write-off of that property over a 39-year period if it's commercial, or if it's residential, including multifamily, over a 27.5-year period. That means you take the whole lump sum, take off a certain amount for land, and then the rest of it you can now take a little bit every single year for that period of time. But what we're talking about today is cost segregation, how you can actually break down that purchase price, that cost, and segregate that into different categories that depreciate on different tax lives. So certain things are on a 5-year schedule, some things on a 7, 15-year schedule, which means you can actually take a lot of that accelerated depreciation up front, and we're going to get bigger tax benefits in the earlier years. So let me just break down a little bit how this works. So what depreciation, just to give you an idea. Let's say you buy a building for $1 million, okay? $1 million. You take off a certain amount for land. 15% is pretty national average. There are certain places and types of property that are going to be more. Some are going to be less land, but land does not depreciate. You're left over with an $850,000 you can now take as a tax deduction called depreciation. I'm just going to say that again and again until it gets into our skulls, right? Doesn't mean it's going down in value. Your property is probably appreciating. It's probably going up in value. Okay. Mm-hmm. So the little bit of depreciation you get every year, it's not a little bit. It's about 2 to 3% of that purchase price. And look at this straight line depreciation, which is what everyone's going to do over a 27.5-year period. That means you take about $30,000 a year per million. So if it's a $100,000 property, about $3,000, right? If it's a commercial property, $21,000 per million. If it is a $100,000 commercial property, $2,000, $2,100 a year. Okay, that's your depreciation deduction, which means this offsets your income tax. You make $50,000 a year from this $1 million property. That's your income tax liability. You automatically deduct $30,000 off the top. Okay, so you're only left paying taxes on the remaining $20,000. That's how regular depreciation works. And the great thing about real estate, which I think we have to really understand, if any of you have worked in a corporate job, or you've worked in a job where you've been paid with a paycheck, W-2, whatever it is, you know that your taxes are actually being deducted from your paycheck before you even see the money. It never makes it to your bank, never makes it to your wallet. Guess what? Real estate's not like that. Real estate is passive income. First of all, your rental income, and you're responsible, even though it could be a business, you're still responsible for claiming how much money was made, and in the end of the year, how much tax liability you're left with. Okay, so if you made $50,000 and now have $50,000 of deductions, guess what? You made $50,000 and you get to keep. You don't pay taxes on zero of it. Why? Because you have those deductions. So it's never being deducted from your paycheck. This is the great thing about real estate, is that you can actually have real cash flow and reinvest that money and never have to pay taxes on it. And this is the greatest thing about depreciation, about real estate.
Absolutely.
Okay, so we're going to get into how this is just straight line, regular depreciation. Cost segregation is going to multiply this by a lot in the first early years. Okay, so what we're doing is, and how this actually works. Okay, I mentioned before, this is something accountants can't do. Why? Because it requires an engineering component to it. So the IRS says that an engineer, someone who has engineering training, construction engineering, and so we have full-time, cost segregation engineers that they're trained in this. They actually have to go to the property. They have to see and take pictures and whole measurements and understand what's in the components of that property. And we're literally breaking it down, like dissecting a property into different components. And it used to be called component depreciation, which makes a lot more sense, which means each individual thing, like the cabinets depreciate on a 5-year schedule. We're going to add up how much of that is. What is that worth? The carpeting also, different things. And we'll give you a list in a moment. And we're going to reclassify those, take those depreciation deductions at a faster rate, giving you, like we just said before, much more cash flow because you don't have to pay taxes on that money.
Mm-hmm.
So here's an example of, this is from a residential property. This is a list of items that our engineer is going to find in a multifamily property. So the basic main categories are the 5-year and 15-year. As I mentioned before, you normally, your straight line depreciation is on a 27.5 or 39-year schedule. That's really the structural components of your building. Okay. But if you just lump everything together over that rate, you're missing out. And actually, it's not even considered the proper way to do this. You're supposed to use the cost segregation method to depreciate each component separately. But the IRS isn't going to make you do it. They're not going to go out of their way to tell you the extra tax deductions you could have. No, you got to figure that out on your own. And your CPA may not even be telling you that. You got to educate yourself.
Absolutely.
But when you go deep into it, you'll see that the IRS actually says this is the right way to do it. And I'll quote, there's a great book, if any of you guys are interested in reading more on the topic and taxes in general, called Tax Free Wealth by Tom Wheelwright from the Rich Dad Advisors. So he was Robert Kiyosaki's accountant. Tom Wheelwright, Tax Free Wealth. He has a whole chapter on depreciation and breaks this down as well. And he says over there, the reason the IRS doesn't tell you have to do this is because they know that because of the laziness of individuals and or their accountants, that just means more revenue for the U.S. government. Like,
no,
that's
absolutely.
all it means.
And not just that, but the one of the things you said, and I tell all the people that, listen, man, don't think your accountant's going to know everything. You get out there, you know everything. Listen to Yonah. Call him up. He's with Madison Specs. And if you want to give your information out, man, I just thank you so much for your time, brother. I mean, this is so valuable. You guys make sure you're writing this down. He's one of the most amazing cost seg in the world. Is his group out here out of New Jersey. So this is an amazing presentation, brother. I'll let you keep moving forward.
All right. Yeah, I appreciate it, Nate. Thanks for the kind words. And yeah, we are we work in all 50 states. So even though we're on that end of the continent, we actually the biggest national company working in all 50 states. So let me break this down again. We're the main structural components, like the roof and the walls and the floor and plumbing and main electrical components. That's all structural. It's infrastructure stuff. That's windows and doors. That's all necessary for the structure. But everything else actually depreciates faster. So here's two categories. We have 5-year property, which is personal property, and we're going to go in there and find stuff like, even stuff that's not, you wouldn't think of that's like personal property. It's movable. Okay, yes, appliances, furniture, you get that, right? It's movable. You can move it around, bookshelves even, but stuff like carpeting, which is attached, or millwork, or window treatments, things like shelving or cabinets or even countertops, all that stuff actually depreciates on a 5-year schedule. It's a lot. I mean, we're talking about usually for multifamily or residential properties, anywhere from 20-25%. It's pretty average that's how much you're going to get to accelerate. So when we're talking about $1 million property, and you can take 20% of that up front in the first 5 years, instead of that $30,000 deduction every year, you're going to be doubling that in the first 5 years, or at least, because you're going to take an extra $200,000 over those first 5 years. That's a huge amount. Okay.
Absolutely.
And the 15-year property, the land improvements, that's the other category that accelerates. You wouldn't even think about this stuff. Oh, what? The pavement, the grass and the landscaping and the fencing. Yeah, all that stuff has value to it. And when you apply that value, you can now take those tax deductions at a faster rate. So basically, general rule is, if you have an opportunity to take tax deductions and not pay tax, do it, right? I mean, this is not some loophole. This is not something that, you have to like file a special thing for. You do have to complete a cost segregation study, which there's a fee, right? A service to get it done. But if you have the option to do it, like, it's almost a no-brainer.
Guys, this is how the wealthy keep from paying taxes. It's not a secret. It's the same IRS code that you have. You just need to hook up with Yonah, and he's going to show you step by step. If you have a building that and let me break down, when he said commercial and residential, 100-unit apartment complexes is still considered residential, correct?
That's right. So apartment complexes, even if it's a 300-unit building, it's still considered residential from this perspective.
Even though it's commercial as far as the banks, but he
Hmm.
can get it's 27 and a half years, but he's going to get you your money quicker. It's like the lottery people say, hey, we want to hang on to your money for 20, 30 years. IRS is the same way, but Yonah can hack around that and get you your money sooner, your write off
That's right.
sooner.
That's right. That's right. Absolutely. That's a great analogy. It is really like the lottery. Like if you have the option, you want to take the lump sum up front or you want to, just take a little bit every year. No,
Hmm.
take the lump sum and it's your money. It's not like it's the government's money. We're talking
Yep.
about
Yep.
your income.
Yep. So it's totally legal not to pay taxes if you do it right. You do a cost
That's right.
seg. There you
Yeah,
go.
I remember a few years back there was this like headlines in the New York Times like Jared Kushner doesn't pay federal income tax, in past 10 years, right? Hasn't paid federal income tax, right? And if you read the fine print, you see that they're making it out to be like it was tax evasion, but it wasn't. It was just headlines to get attention and to get people's emotions because that's what news does.
Yep.
But in the end of the day, it's because he uses real estate and tax strategies. And I know this for a fact because we actually do all the cost segregation for the Kushner family companies. So we know that that's what they're doing. And that's how you can have a net worth of hundreds of millions of dollars and not pay a cent in federal income tax legally.
Absolutely. Absolutely.
So we asked like what types of properties is this going to be good for? And it can be for single families, can be for anything, but each type of property is going to have a different percentage on average of how much is reallocated to these faster depreciation schedules. Okay. So apartments, typically speaking, is between 25 and 30%. Single family is going to be a little bit less, usually closer to between 15 and 20% is going to be allocated. Although that does depend as well, because like I mentioned, the landscaping and land improvements. If you have a beautiful property that has a lot of landscaping, a lot of land improvements around there, like very, very nice, or huge driveways and stuff like that, all that can actually be deducted on a 15-year schedule, and so there will have a higher percentage. Retail, hotels, that stuff has 35, 40%. Manufacturing facilities a little bit even more, and you'll see mobile home parks at the second to bottom is literally off the charts. And the reason why
Wow.
that is because mobile home parks are um, typically almost all land improvements. We mentioned land doesn't depreciate, right? The land doesn't, but whatever you're allocating beyond land, and even if it's 50% is to land and the rest of it is to land improvements, still you're going to get 50 to 80% of the property reallocated to the faster depreciation, either to the 15 years, or if you actually own the mobile homes, a lot of times those homes are still considered personal property because they're movable. If they still have the wheels on them, like a lot of mobile homes actually still have, and you own those as a park owner, park owned homes, they're on a 5-year schedule. So there's a huge amount that we can now depreciate on a faster rate. And one of the reasons why mobile home parks has actually had such a huge uptick of sales in the past couple years because of this thing we're going to talk about in a few minutes called bonus depreciation. You can take all that upfront in the first year, all that
Wow.
depreciation.
Wow. So you're going to show them how they can take all of their items that are under 15 years. Is it under 15 years or?
Yeah, that's right. It's under 20 years, but essentially there's nothing on a 20. But yeah, everything is 15, all the stuff we talked about, the cost segregation, you can take that all up front in the first year.
Man, that is amazing, brother. And so I hear people all the time, they say, well, Donald Trump, his tax returns. And I'm like, hey, man, if you own $5 or $10 billion worth of property, you ain't paying no taxes, right? And so,
Yeah.
man, that's just, you know, if you could break that down a little more for people, what 5 billion, 10 billion looks like. Um, I mean, it's a huge, it's several $100 million a year in straight line depreciation, and I guarantee
Right.
you they ain't straight lining the depreciation.
Yeah. Absolutely. And the great thing about this is that even if you have more deductions than you have income, right? It doesn't go away. You don't lose those extra deductions. So
Yep.
I'll break that down for you right here. Let's see what's the next slide over here. Yeah. So what we're doing with cost segregation, I'll break it down why this is increasing our cash flow. Just to reiterate, we're reducing our tax liability. So let's say, for example, in our example, we had $1 million property, okay, and you made $50,000 a year in income from it, and you did cost segregation. You got $200,000 of depreciation in the first year with bonus depreciation, right? But you're only making $50,000 from it. So what do you do with that extra 150,000? The 50, you're not paying any taxes on it. That's great. Okay. What happens to the extra $150,000? It doesn't disappear. It creates what's called a passive loss. It goes into like an imaginary bank account and it carries forward, which means you can use that in the future year. You can use that next year as a tax deduction. Or alternatively, if you are a real estate professional, which we're going to define in a few minutes, you can actually use that against your ordinary income or income from other sources as well. So, someone who has $1 billion of property and they're, making millions of dollars or tens of millions of dollars in income, right? But they have hundreds of millions of dollars, tens of millions of dollars of tax deductions. They're never going to be paying taxes because they have such a huge loss that even if they do have a big tax liability for something else, those losses that are carrying forward are going to be offset from that. And that's why it's so important to have have tax advisors, not just an accountant that's punching numbers, but actually someone that, while you're growing your wealth, to kind of direct you to make sure that you're making those right choices and seeing how you can plan for the future, not just how to punch the numbers this year. But essentially, what this is what's called the time value of money. Okay, because a dollar today is worth more than a dollar 5 years from now.
Yep.
So that's like what Nate was saying, right? You better to take the big lump sum this year, because what can you do with your money,
Yep.
right? Do you
Absolutely.
trust that Uncle Sam is going to be using your money well, right? You just want to give him. You're not obligated to. You have a way not to pay any taxes. Would you rather pay it because you think Uncle Sam's going to do a better job with it than you will?
Mm-hmm.
I don't think so. So if you can make more money on your own money, right? Reinvest that, put it back into your property, buy new properties, right? You have more money to play with. That's what's going to scale you up. Having more money, paying no taxes legally, that's the biggest way to scale up. Okay. And so let's talk about this a little bit more. Who should be doing this? Can anyone do this? Is this for anyone? Yes. This is basically for anyone. As long as you have a tax liability, this is for you. If it doesn't matter how you hold the property as an individual, as an estate, as a corporation, LLC, it does not matter how the property is held, because it's going to pass through. It's going to be, you're going to have ownership of that property. The only exceptions that would be the case are, for example, a nonprofit. Okay, so if you buy the property in a nonprofit, they won't get the tax deductions from that. Another really popular form of investing is through your retirement accounts. And Nate, I don't know if you've had anyone speak about this before, but it's a huge topic, something really important, that people that have retirement accounts, you can use that money. You can self-direct that. You can actually take advantage of that and put that into investments while still in that tax shelter. So you're not actually pulling the money out. We're actually talking about investing that money while it's still sitting in the 401k or the Roth IRA or whatever. You can invest that in real estate, and that makes money still sitting in that account. So it's wealth building, it's generational. It's not something you're going to be making that cash flow from right now, but you also don't get the tax deductions from that because it's not taxable income. So that's another important, kind of to understand. There are a lot of people that are using these, especially syndications, kind of bringing in money from people's retirement accounts and stuff like that. So important to know who can benefit and who can't. So really important, probably the most important slide that we're going to take away from today is what's called the real estate professional. Is a complicated tax law, but bring this up with your accountant. It's something that you should try to qualify for. And it's not like a box you're checking your tax in. It's just something that if you do this, then you get these special privileges. Okay, so we're going to talk about what those special privileges are in a second. But first, let me explain how real estate rental income works. Okay. Rental income is treated differently than your normal job income, right? Your job, your W-2, whatever job you have, that's considered active income that goes in your tax return, your Schedule C. Okay. Passive income, rental property income, that's Schedule E, which means it's passive income. It's treated differently. Okay. It's taxed at a different rate. And depreciation deductions go against your passive income. Okay. So I want to clear up there's a lot of misinformation out there on the internet, like doing cost segregation and tax deductions are great. You can, knock off your W-2. It's not true. Especially not in most cases. There are certain cases where it does apply, but essentially if you have a W-2 job, the cost segregation is not really going to help you that much beyond your rental income. So if you have a lot of rental property income, you want to make sure that you're not paying tax on that for sure. But unless you're a real estate professional, you're going to be limited to how much of that depreciation or that cost segregation you can use beyond that. Okay.
So
So
Yonah,
yeah.
tell them, is there a way, let's say the husband is a W-2 employee, high net worth, 400, 500,000 a year. The wife starts investing in real estate, takes off. She starts getting $500,000 a year in depreciation. Let's say she starts buying a lot of property. Would her 500,000, if she's a real estate professional, wipe out her husband's income and essentially have them at zero taxes?
You got that right. I mean, in
Wow,
certain
you guys hear
cases,
that? Do you hear that? So, man, there's always ways to get things done, but that's why he said this is the most important slide here. Because if you're
that's right.
paying taxes, there's not always a way that you can keep from doing that. But if you're W-2 and your spouse is not, then maybe, there's some things that you guys can strategize, especially if you have some money to invest, and talk to Yonah and be strategic about it. This is what wealthy people do, guys. They quite honestly, they don't give a lot of their money away, and seems unfair that you have a different tax code than the rest of the working
That's
people,
right.
but you do.
That's right.
A
It
different
is.
tax code, all for you.
Yeah, it does seem unfair, but you're absolutely right. And that's probably the most important part over here is that only one spouse needs to qualify as a real estate professional to get this tax benefit. Okay. And essentially what it means is, like I said, your rental income, that's going to be taxed as passive income. Your depreciation is going to go against that. Anything beyond that, like in our example, we had $50,000 of income, $200,000 of deductions. Those extra deductions create a passive loss. But guess
Mhm.
what? If you're a real estate professional, you or your spouse, you can use that extra losses to offset your spouse's W2 income or any income that you have. Even if you're both real estate professionals, let's say you're doing syndications, you're making a big asset fee, or you're doing flipping houses, or you're wholesaling properties, or you're doing fix and flips and all kinds of stuff, and you have income, or you're a broker and you're making money. You're a real estate professional. All that money that's made doing wholesaling, fix and flips, brokering, that's all active income, and that's taxed at the highest rate possible. You need to get rental properties to get the
Absolutely.
depreciation benefits in order to offset that, because it's a huge tax liability you can potentially have. But you're in the real estate business already. You may as well take advantage of the tax law that applies to you.
Man, good stuff, man. Good stuff, brother.
Yeah, I mean,
Man, you
this is
make me want you make me want to go well, actually I'm already doing it, man. So thank you.
we all got to do
I'm
it.
going to go buy
This is
some
really
more property after listening to this, man.
that's right. It's something. I have some clients that are in the fix and flips. In fact, one client comes to mind, a great guy, also out here in New Jersey, and he was doing with this company. They were doing over 150 fix and flips a year. Okay,
Wow.
and making a lot of money. And he realized he was making a lot of money, but getting taxed a lot on that. And he ended up just buying some rental properties also on the side to get the tax benefits. And he realized, wait a second, why am I focusing all of my energies in the fix and flips when I can be making so much more money in the rentals themselves and get the tax benefits come along with it? He literally switched his gears totally and went full time into multifamily, into self storage, into rental properties because of the tax benefits come
And
along with it. But even if you are going to be staying in the fix and flips or other that stuff, make sure to get rental properties on the side and hold some of those properties for
so
rentals.
so Yonah, our group is BRRRR. It's all buy. We teach them how to buy. We teach them how to buy in areas where you're going to get
Hmm.
where we think you're going to get 5 to 6 to 7% appreciation. Now we know things are going crazy and you can get 10 to 15%, but that's not normal. So what would your advice be to people that are doing single family homes, and what kind of path do they have to being able to use this special tax code as a real estate professional?
Yeah, make sure to use it. I mean, it's as simple as that. Even though the tax basis is going to be less and the tax benefits are going to be proportionally less, but you can still figure out a way to get those bonus depreciation, get those extra deductions, and use them to make sure that you can scale your business. Because the more money you have, the less you're paying taxes, the more you can reinvest and
And
just grow that.
And at what point are you guys able to help them? Because I know on a single family home,
Hmm.
100,000, $200,000 single family home, it's probably not going to be advantageous. But at what point are you guys really your sweet spot to be above the where you say, hey, listen, man, I can really help you guys out?
Yeah, we always run a free analysis for anyone ahead of time. So you can know ahead of time what any specific property, what the tax benefits are going to be. But my usual rule of thumb is any property purchased for over $500,000, And again, it's based on the purchase price, not necessarily how much money you put in. So it could be seller financed. It could be, putting down 5, 10%, whatever it is. It's based on the purchase price. Anything over $500,000 purchase price, it's a 10x, return on investment. I mean,
Wow,
it's a
10x.
no-brainer. It's a
Wait,
no-brainer. I mean, it costs a few $1,000s to get a study done, right? But if you're getting on a $500,000 property, 70 to 80, $100,000 of tax benefits, even to pay $5,000 for that,
yep.
It's a no-brainer. So the less the property is, again, the less proportion of those tax benefits are going to be. If you're talking about a $100,000 property, you may be getting about $10,000 or so, maybe $20,000 of extra tax benefit. But is that going to be worth it? Is it worth to pay a couple of thousand? Some people it will be. Again, if you're that real estate professional and you can use those to offset your other income, it may very well be, because better to, like I had a client just last week. He said his CPA told him, if I can pay $4,000 to get a $20,000 tax deduction, it makes sense.
Yeah, if you're in the 30% tax bracket, then that's $6,000 versus $4,000. So, and then are you able to write the $4,000 off too?
The $4,000 is a business expense.
Ding,
Yeah,
ding,
so
ding,
that's a
ding,
tax
ding,
write-off.
ding, ding. So look, you see that, guys? Bonus hack, bonus hack. So, hey, what if they buy, let's say, 4 or 5 single family homes that are kind of contiguous on the same street?
Mhm.
Then is that a little more advantageous? They get $600,000-$700,000 worth of value. Is that something they should be saying? Hey, man, I need to call Yonah up.
Yeah, definitely. And you could definitely do it. Definitely do it on smaller properties as well. It's certainly something we can look into, and certainly something worth having the conversation, because once you see the numbers in front of your eyes, and we're going to do a case study in a couple minutes here, and we'll see what the numbers are. But it just speaks volumes to what you can actually walk away with.
Man, that's awesome.
Um,
Awesome info, man.
Yeah. So let me just finish up here what this real estate professional is. For you, in order for you or your spouse to qualify, you basically need 2 qualifications. Number one, you can't have a W-2 job. You need to be full-time in real estate. Specifically, the tax code says more than half of your time, more than 50% of your time. But in every single court case that has come about surrounding this, the IRS has adjudicated basically that if you have a W-2 job, you cannot also claim this status. So that's the difference between written law and the actual court cases that come out of it, the rulings. So we're going to go with that. You can't have a W-2 job. You need to be full-time in real estate, and you have to spend at least 750 hours a year, which is not a lot. It's only about 16 hours a week. But again, you need to actually be spending those hours doing what's called materially participating in that. So that can include anything from developing, really redeveloping, constructing, reconstructing, acquiring. Okay, so that can be involved in the actual acquisition process, converting, renting, leasing, operating, managing, or brokering properties. Any of these activities are defined as the IRS as activities that can qualify the hours spent doing these. You are a real estate professional. Again, only one of a couple. Okay, so if one spouse has it and the other spouse doesn't, you still qualify, and you can now use those extra tax deductions to offset your, both of your income. Okay, there is one exception to this. The one exception is that if you make less than $100,000 of adjusted gross income, okay, so you take your total gross income before taxes and before expenses, and you make less than 100,000 of that, you can use up to $25,000 of these passive losses against your ordinary income. Okay, so just break it down. And let's take our example again. You had $1 million property, you're making $50,000 from that. Okay, and your spouse makes $50,000. So together it's $100,000, right? And now but you're not a real estate professional, because you're both W-2s and you just have this rental property, right? You get to now use, besides the 50,000 on your rental income you're not paying tax on, you can take some of those passive losses and use up to 25,000 of that to offset your ordinary income as well. So this is the one exception where if you have a low enough adjusted gross income, you can then use some of these tax benefits against your active income. So the tax cuts job we mentioned, the tax reform that happened a few years ago, which was a huge benefit, created this thing called bonus depreciation, which we mentioned, we alluded to a couple times already. But essentially what it means is, once you've done a cost segregation study and you've allocated the property into these different categories, So you got the 5-year property, which personal property depreciates on a 5-year schedule. You got all that, again, all the appliances, furniture, carpeting, cabinets, all that good stuff. And you have the 15-year property, which is all the land improvements, all the landscaping and pavement, the sidewalks, all that stuff. All of that now you have the option to use that all upfront in the first year. 100% of that as a tax deduction in the first year. And so this is the biggest game changer that happened in in the past 30 years, basically, in the real estate industry.
Wait, Yonah, hold on. So in your example before, you had 850,000, and let's say 30% of that, which is, let's just say $250,000 of that you're able to get under the 15 years, under the 20 years. You're telling me that potentially, even though you didn't pay $1 million for this, you paid $1 million for the building, you borrowed the money from the bank, you maybe put 20% down, you put $200,000 down, and you could potentially get a $250,000 write-off year one?
That's right.
Wow. That's amazing, guys. Man, that's good stuff.
It's mind-blowing. It's crazy. And especially when you think about, mobile home parks and things like that, where you have a huge amount of tax deductions in the first year. We're talking about like 50 to 80%. Take your example again, that $1 million property, you put 20% down, and instead of a $250,000, you can take a $500,000 or $750,000 write-off in the first year.
Yep.
It's crazy.
Well, Yonah, I remember me and Mike's first hotel we bought, man, and they gave us, the FF&E, and then we, we got $700,000 a piece on bonus depreciation. I was like, ding, 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 ding. Use it all, carry it forward, do it again. And guys, look, man, this stuff here, what he's telling you is very high level, man. Most accountants that I've ever even talked to either give bad advice and tell people, well, you don't want to use all that right now. Why not? You want the government to hang on to your money? What are they going to do with it? Or 2, they don't even know how to do it. So, man, you guys make sure you contact him for all your needs, man. He is the best I've ever seen out here. And I'll let you continue, man, but that's mind blowing, brother.
Yeah, absolutely. And, remember, this is income tax we're talking about. Unfortunately, we're not going to be able to help with the property tax. Property tax is something else and something you got to really pay attention to, obviously, especially, if it gets reassessed, you can have higher property taxes. But this can help with, again, with the income tax. So let's just take this away, right? When should you be doing this? Can it be done in the first year? Does it need to be done in the second year? When are you doing this? Even though most people try to get this done in the first year, right, to make sure you're set up, your taxes for the property set up the right way from the beginning, right? That's the best way to do it. And so most people reach out to us even before they buy a property, even when they're under contract. They want to see what are the tax benefits going to be. And so we'll get that free analysis to show you. But get it done right away. And even if you own a property for a number of years and never did this, you can actually go back and do what's called a look back study. You can get this retroactively to get all the benefits that you missed and catch up all those accelerated depreciation deductions that you missed in previous years. And that is done without amending your tax returns. Is a huge, huge, huge benefit. So I mentioned at the very beginning, right? Your tax basis is totally based on your purchase price, correct? It doesn't change if you get a new appraisal. Unfortunately, even if the property is worth, 5 times more, doesn't matter. How much you could deduct from your income tax is based depreciation on your purchase price, and that's it. The only time that changes is when you add more money into the property. So if you're doing a renovation, you're adding capital in there. That money spent is depreciated. Now you can take all of that money as a tax deduction. That is all depreciated. And if you're doing stuff like, putting in new kitchens, putting in new cabinets, new appliances, doing a new parking lot, all that stuff is depreciated faster. You can get sometimes on the renovations itself, 50, 70% of the renovation costs can be bonus depreciated as well. So make sure to get it done both on the purchase and on the renovations when you're getting this done. Okay, so let's jump right into this case study. Okay, this is a great story and someone, something that people, think this can happen to me. Yes, this can happen to you. Listen to this story. A lot of you may be in single families. You may have heard of the 1031 exchange, right? You heard of the 1031 exchange? That means that when you sell a property, if doing it the right way, you can actually exchange your property for another property. And by doing that, you would avoid paying capital gains tax. It's a great strategy. It has to be done properly with the right, team, etc. what happens if you try to do a 1031 exchange and you fail? You don't find the right property and you're left with this, you sold the properties, you couldn't find a replacement property. There's a whole window of, 180 days, you got to close, 45 days to find it. It's difficult to jump through those hoops. Happens. People miss that window. And this guy, right, he bought his first multifamily building. It was a 32 unit in North Carolina. And he sold a bunch of single families that he owned before that. And he had a huge capital gains tax because he missed the 1031 exchange. And what happened? He was going to be faced with this year or that year about a $250,000 capital gains tax bill, because that's how much money, right? He paid. It was 25% or something. He made like $1 million on the sale of all these properties after many years, and he's going to be paying a huge bill. And so some people might tell you, and if you've ever heard this before, let me know, right? Oh, if you're paying a lot of taxes, it means you're making a lot of money, right? That's a good thing, right? You ever heard that?
Yeah.
It's such a lie. That's not a good thing. If you're in real estate and you're paying a lot of taxes, that just means that you're not using the right strategies. Yes, absolutely. You may be making a lot of money. That's true, but you should not have to be paying taxes on that with the right strategy. So this guy, he was going to be hit with this bill. He heard about cost segregation. We talked about it. With ordinary depreciation on this property, again, 1.75 million. It wasn't a huge deal for it. It was, it was big, but it was regular depreciation would have gotten him $54,000 a year. That's straight line depreciation. Again, we're taking off 15% for land. But this is what we did. We were able to find 28% of the property in faster depreciation. And so pretty average for a multifamily. It wasn't, a huge amount, but look at what we did over here. We got 15% to land, the remaining amount over $1 million. That's what's in the structure, 72%. But in the 15-year, the landscaping, the fencing, the pavement, $122,000. And in the 5-year property, that's all the personal property, close to $300,000. So altogether, we're talking about close to $422,000 of tax deductions as bonus depreciation.
Wow.
So not only did he knock off his entire income tax liability, which was about $120,000 from this rental property, but he also was able to use the rest of those losses, guess what? To offset that capital gains tax that he would have had to pay. So he ended up having not to pay any taxes. So
that's that's an amazing strategy there. That's awesome.
That's right. And so it's another thing that, you may not have thought about. What happens if you fail a 1031 exchange? What can you do about it? Well, one thing you can do, not necessarily for everyone, but it's a good strategy to know about. You can buy a property, get a cost segregation study done, and use the bonus depreciation to not pay that capital gains tax.
Oh, that's amazing.
Yeah, it's not necessarily for everyone because, again, the capital gains tax is usually at a lower rate than your ordinary income tax is. So you're using these deductions from depreciation that could potentially offset a higher income tax rate and using them to offset capital gains, but it still can be done, right?
So anybody who has a 1031 that failed and you're thinking you're going to be crushed with all these taxes, man, get a hold of Yonah. I mean, this is genius right here, what they did. And again, guys, you're not only leveraging the bank's money, you're leveraging the amount of assets that you own, which you're able to get appreciation on, and also cost seg. So you're getting all around bonuses. I never understood. I understand why 88% of millionaires are self-made. And now I understand why 90% of them make their money in real estate. It's because they get to keep their money.
That's right. That's absolutely right. Like I mentioned before, this is a pretty complicated thing. I try to simplify it. We try to make it simple to understand, but it is a pretty complicated, tax law. Okay. And so in the tax, it's called the Cost Segregation Audit Techniques Guide. There's a lot of principles that go into getting a cost segregation done. It's not just something you can come up with these numbers and just throw a dart at the wall, figure out how, I'll take 5% here and 20% here. There's a very detailed report that needs to come along with it. There's a whole numbering system. There's a whole nomenclature. There's a whole, report. We're talking about like an 80, 90-page report that we create. In the end of the day, it creates a new depreciation schedule, and that one page is what you apply to your taxes. But in order to get this done, you want to make sure you're following the rules, okay? Don't try to do it on your own. It's just going to get you into trouble, right? You want to make sure we're doing
Yonah,
it right.
They're paying you the money for that one page, and the other 89 pages are just a bonus.
That's for, yeah, exactly.
That's for if the IRS ever says anything, you have real data you know, analytical data, just great pictures, great documentation.
Exactly.
So, hey, man, that's you know, make sure you guys check them out, Madison Specs, and make sure you share your information on here too, brother. If you can put that up on the
Yeah.
screen,
Here
because
it
I'm
is
sure a
right
lot of
there.
people right now are saying, "Hey, man, how do I get a hold of him? I don't even need to see anymore." You know, they got problems, and he can put out the fire for you. You
Yeah.
guys
And
got that? Yonah Weiss, 732-298-9002. If you're listening in the car, yweiss at madisonspecs.com
yeah.
or yonahweiss.com. That's YONAHWEISS.com. Man, so I'll let you continue, brother, but just want to make sure we got that out and make sure you give them that again at the end, guys. So get your pen and paper ready.
That's right. Yeah. So, that's pretty much it. I mean, I'm happy to answer questions at this point. There are a couple, I will just share with you a couple times where this may not make sense for everyone, but feel free to reach out to me. I'm pretty active on Facebook, on LinkedIn. So you can find me over there. Instagram also. There's only one Yonah Weiss out there, my friends. So
There's only
I'm the guy.
one.
That's me.
You know, but you answered, man. I mean, I had some questions written down, but you answered everything. So sometimes you just got to keep your mouth shut and listen. My main thing was if I'm a high net worth. You answered all that though. So with the spouse,
That's right. Yeah. I would say that if you're not the real estate professional and you're not and you don't have a lot of tax liability for your properties, this may not benefit you at all, right? It may not be good for you. If the property is too small, this is just going to be kind of like a waste of time, especially if your regular depreciation, sometimes you're not making money from your property and some properties just are not cash flowing, right? Or maybe doing major renovations and there's already enough losses from the expenses there. It's not going to make sense to get these deductions if you're not a real estate professional.
then you need to sell that property and contact me because I don't lose money on properties. But another thing, if you are both high net worth individual W-2 employees, is there any way or any way at all for them to become real estate professionals if they're both W-2?
Not really. I mean, essentially, if you are a W-2 employee, you can't get that real estate professional status. The only thing I would say is that whatever money you do have, invest it into real estate and make money on that. So at least you have another stream of income that is not taxed through that. And, you can help, start to build it that way or figure out, make the calculations and figure out a way that maybe you're making more money non-taxed through the real estate than if you would stay with your W-2 jobs, both of you. And I
Absolutely.
have a lot of clients that have done that. Like one spouse is just like, numbers make sense. I'll just
Yep.
quit my job
Y'all just
and
quit my
manage the
job.
properties.
Yeah. Yeah, I know, absolutely, man. So I remember we were doing one years ago and I met a couple and it's all about what are your options. But like he said, hey, maybe you're only making 100,000 a year and your spouse making 400, you quit and you get a $400,000 write-off. I mean, so you just got to run the numbers.
Yeah.
Man, great stuff, Yonah. Great stuff, man. Thank you for your time, brother. And Yonah, man, I want to just thank you for your time, brother. You guys make sure you go check him out on Instagram. And like he said, there is only one Yonah Weiss. Thank you so much for your time, Yonah. You guys got it right here. 732-298-9002. Madison Specs. Man, they are, like you said, they do very, very wealthy billionaires. This is a place where the billionaires go, guys. So make sure you reach out to him. Yonah, thank you so much for your time, man. As always, man, it was great talking to you and seeing you, brother. And look forward to seeing you soon, man.
Thank you, Nate. It's been a pleasure. It really has.
My pleasure, man. Thank you, brother. Sure, you hit the like button, subscribe to our channel, Nate Barger on YouTube, and hit the bell. And you'll be notified on any new videos that come out.